Good afternoon. Welcome, Danberry agents. It looks like some people are continuing to get on, so we'll kind of take a slow start here. But just want to welcome you all. We're excited that you can be here today, and hopefully we'll learn a little something about taxes and some ways you can save some tax dollars here going forward. So my name is Amy Merkel. I am a senior tax manager with Gilmore Jason Mahler accounting firm. And joining me here is Marie Sainer. She is also a tax manager at the firm. And we both work on the Danberry account, and we're asked to do a presentation to all of you to kind of help you with some tax planning ideas. And so hopefully, like I said, hopefully you'll learn a little something today. The plan for the next hour or so is just to sort of go over a sort of a general overview of tax deductions that relate to self-employed individuals. We're also going to talk about some sort of more recent developments and some ideas of things you can do to, save some tax dollars and help your company. So hopefully, hopefully we can cover and answer your questions that you may have, cover as much as we can in an hour, but we certainly can't go terribly in depth, can't cover everything in the tax code that relates to you, but we will cover as much as we can and hopefully some very pertinent information for you. You will see too on our call we have Susan and Kelly from our office. They were the organizers for this go-to webinar, and so if you do have any questions, you can put them in that little question area on the bottom of your screen where the question mark is, and they'll be monitoring those for us. And like I said, at the end we will circle back to those and try and address as many of those as we can. I think Marie is going to be the one to get us started here. She is going to flip screens here for you. She is going to just sort of cover the common business deductions that you would typically recognize on your Schedule C form that you would file with your 1040. So take it away, Marie.
Okay. We tried to choose some of the most common business deductions, although it's not all encompassing, but these are the most common that you're going to see. Business auto expenses. There are two methods you can use when you're deducting your auto expenses. There's the actual cost, which you can use your actual gas, tolls, insurance, parking, repairs, the cost of your car, loan interest, and depreciation, just based on the business usage of your car. And the other method is just using the standard mileage, which the IRS publishes each year what the standard mileage rate is. And you just multiply your number of business miles by the rate and come up with your deduction. And then you can also include with that method tolls, parking, and a portion of your loan interest on your car. The biggest thing with this is you really need to keep good records. They like you to keep a log with where you went, why you went, and who you met with, the date, the number of miles. So it seems a little tedious, but it's good to keep a good record if they ever want to come and look at your, in the event of an audit, they might want to see your backup for your deduction. Moving on with cell phone, you can deduct a portion of your phone cost, not the entire plan, but the business portion. The same goes for internet, and you're able to deduct for gifts if you give out a little gift for your clients when you make a sale, up to a $25 limit on gifts. You're able to deduct dues and fees for your various professional associations, your MLS, maybe if you join the Chamber of Commerce, there's a variety of dues and fees that you can deduct. Business meals. You can deduct business meals for 2020, the amount is 50% of the cost is deductible. But with the latest tax stimulus that came through for 2020 or 21 and 22, business meals are going to be 100% deductible. if it's provided by a restaurant. And this is another area why you want to keep good records. You should mark down, when you went, who you met with, what was the business purpose if it's a business meal. Another piece of it that you can deduct, and it's always 100%, is if you sponsor an open house and you provide snacks at the open house, you can deduct those. Moving on, you are able to deduct costs for your office supplies, business cards, stationery, what have you. Also, that leading into your advertising and promotional materials. And you can also possibly deduct for an home office expense. There are some strict rules for if you qualify to make this deduction. As long as you're conducting business in your home and you have a dedicated space that's not used personally, you can deduct based on the portion of your home, the square footage of your office space. You can take a deduction for that. Or if you're paying desk fees at the office, that is something you can deduct. Continuing education, if you attend seminars or training classes, those are deductible. The travel that is included with that is the lodging, tickets, if you have to take Uber or taxi to get around, any other costs that might fall into attending the training, or if it's a convention, can be deductible. And lastly, professional fees. If you pay a portion of what you pay to have your taxes done, maybe just a piece of that could be deducted as a business expense. Any legal fees that you might incur. I think that's about covers it. Amy is
Okay.
gonna, okay.
Thank you, Marie. All right, so I'm going to move on to some other deductions that you can take on your return. The deductions that Marie was discussing there were ones that you really would be taking on your Schedule C form that's filed with your 1040, where I'm going to be discussing deductions that are taken elsewhere on the 1040. And one of those largest deductions available to you, especially as a self-employed individual, is through retirement plans. In general, I'm sure you're familiar with how retirement plans work. You put money in, typically, unless you're doing a Roth, typically the money you put in is a tax deduction, and then it earns tax deferred until you pull it out someday. So obviously, this is something that the earlier you start, the better off you're going to be, and the more you'll be able to get saved for retirement, growing tax-free or tax deferred. One thing to keep in mind, the contributions are limited on an annual basis. So you can't go back and make up for years you didn't do it. So the earlier you start and the more you can do each year, the better off you're going to be. For self-employed individuals like you, there are a couple of different plans you can use. The most popular ones would be the SEP or the simple IRAs. They're both easy to organize, easy to set up. There's no annual filings. Typically very low fees. They're just treated like an IRA account, but they give much larger deductions for self-employed individuals than what you could do through just a regular IRA. So for instance, a SEP plan in general is based on a 20% deduction of your net income on your Schedule C, up to $285,000 for 2020. So you could do up to a max of $57,000 for 2020. The great thing about the SEP plan is that if you haven't already set one up or aren't already using one, you could still get it set up now for the 2020 tax year. You have until the due date of the tax return, or even the extended due date. If you extend your return until September 15th, you have all the way until September 15th to get that SEP plan set up. Typically, you would use like a broker to do that. And you would have until then to get it set up and to fund it for 2020. A simple plan, you can do up to $13,500 per year, so still better than a traditional IRA. That one, however, you're too late for 2020. If you don't already have one set up, you would have to have that set up by October 1st of the year that you're going to contribute. So you could do that now for the 2021 year and still be able to contribute before the end of the year. And then of course you have other traditional and Roth IRAs. There's also other plans that you could use, other accountable plans. The problem is most of them get more costly to administer. These are ones that are simple to administer. So I'd highly recommend you consider saving for retirement if you haven't done that already. Second bullet here I have is self-employed health insurance. When you're an employee somewhere and you pay for your health insurance through your employer, it would be withheld from your pay pre-tax. So the fact that you're self-employed, there's no way to have that withheld pre-tax. So the IRS gives you a deduction on your tax return for those health insurance costs that you've paid for you or your family, as long as it's in your name or your business name. You can deduct those on your Schedule C, and so you get that same pre-tax treatment that other employed people get. So don't forget that deduction. And Medicare, you cannot do this if you are covered under Medicare. Health savings account, another great option, actually one of the best tax deferred tax savings types options that is available. I highly recommend, if you are covered by a high deductible health plan, that you consider opening a health savings account if you have not already. It is a fantastic way to get money, to shelter money from taxes. So if you have a high deductible plan, the idea of this is that deductible portion that you may end up having to pay for your health costs every year, you could use the funds from the savings account that you have to pay for those with pre-tax dollars. So if you have, for instance, a plan that is for you and your family, you can, and it's a high deductible plan, you can put in $7,100 per year and take a tax deduction for that. Those funds, then it's basically just a savings account. So those funds can sit in the savings account and grow and earn and grow tax-free all the way until you ever take them out. And actually, the beauty of it is you don't have to take them out, where retirement plans usually have a forced age where you have to start taking out retirement distributions because the IRS wants you to pay tax on those dollars when you pull them out. Health savings accounts don't have those rules. So you can leave the money sit there, pass it on to your heirs. If you do want to pull it out, you can pull it out for medical costs tax-free. So a great vehicle, and strongly recommend you look into those. 199A, this is the 20% qualified business income deduction. I'm sure you all heard about this in the news a few years ago. This was sort of a big deal when it passed as part of the Tax Cut and Jobs Act. If you remember back then, when this was Trump's tax deal, and he wanted to drop the tax rate for corporate businesses, and so he dropped the corporate rate down to 20%. So at the same time, they were looking for a way to give a tax savings or decrease the tax that was being paid for small businesses. And so this applies to flow-through income from LLCs and S corps, and also for your self-employed business that you have. Basically, it's a 20% deduction of that net income on your Schedule C in general. Now, there's a number of different limitations and things that you have to look at. The biggest one is if your income, if your taxable income, not just from your business, but all of your taxable income on your tax return is greater than $386,000, you'll lose the deduction. So if your income's lower than that, you should get basically a 20% deduction for your income on your Schedule C. So make sure you're not missing taking advantage of that deduction. Again, all of these deductions on this slide are elsewhere in your 1040. So sometimes we forget about them, maybe when you're preparing your 1040, since they're not showing up on that Schedule C, but they are deductions that are available to you. Could have put a fifth bullet on here, that's really quite a benefit to you that I did not include, and that would be, being your own boss. I mean, let's be honest, it's a huge benefit to being self-employed. However, unfortunately, there's not a tax deduction for that, so no bullet point there. Move on to the next slide here. Oops, missed it. the don't forget slide. These are just a number of items that we wanted to make sure that we were mentioning to you. I'll cover the first couple and then I'll move on to Marie to cover a few. Hiring family members, just something to keep in mind if you have, especially children less than 18. There's a sort of a loophole, I guess I'd say, or a qualification in the code that you don't have to pay FICA or Medicare taxes on your children that you employ who are less than 18. It also would obviously be a deduction to you on your Schedule C, so reduce your taxable income and shift that income to family members who are at a much lower rate. And actually, with the Tax Cut and Jobs Act and the increase in the standard deduction that people get now in their returns, including your children, they can really earn the first $12,000 of their income is not taxed. So a great way to shift some income to them and pay no tax on it. And they could also put that into, a Roth IRA or something as well, as it would be considered earned income. So a really great vehicle. Put those kids to work. They know social media. Get them, working on your your websites and your posts, and the houses you have, or putting together, or taking your pictures, maybe working at your Sunday open houses or whatever. Get them earning their keep. So number 2 here, expensing of office equipment. Just a reminder to make sure you're taking advantage of the immediate expensing you can take, which is called bonus depreciation. If you're buying laptops or cameras or anything you're using for your business, any kind of desks, chairs, whatever, you can immediately deduct those as a bonus deduction. In the past, you may have thought of this or heard of as 179 expense. That still is around. You were limited in taking that though based on your income and what 179 deductions you had coming through from other entities and that type of thing. The new rules for this bonus depreciation is much more open to you to just really take that on everything that you purchase. There is limitations for autos, however. The next section, and the section I thought I probably would spend the most time on, quite honestly, here is the PPP loans. Again, I'm sure you've heard of these. Hopefully, you've already taken advantage of them. It's called the Paycheck Protection Program that came out of the CARES Act last March. And these are available to small businesses, including self-employed people. And so the idea of this, when this was passed last spring, was that the government was trying to make money available to small businesses who were hurting as soon as the pandemic hit, and trying to get small businesses to continue paying their employees, keeping their employees employed, and keeping the economy running. They did not forget about self-employed individuals. And so this also applies to you. And obviously you don't have wages. This was primarily calculated based on wages. But for self-employed individuals, you would base this on the net income that you had on your Schedule C tax return. So last spring when this opened up, it was based on your 2019 net income on your Schedule C. And so at that point, you would take whatever your net income was, and you would take the maximum amount of 100,000. You were considered basically like an employee of your business, just as owners and small businesses were limited to 100,000 of wages. You are limited to 100,000 per year. So you would take the net income on your Schedule C from 2019, as long as it was not more than 100,000, or else you'd limit it to that 100,000, divide it by 12 for 12 months, and times it by 2.5 months, which gives you $20,833 that you were allowed to get access to. So we are now, with this latest tax stimulus bill, there's a second draw that's opening up. So if you did apply for these loans last summer, you are now able to take a second draw of the same amount. And so you can look into that with your bankers. These are supposed to be opening up this week. However, I checked with the bank earlier in the week, and they just were not ready yet, nor was the SBA. So maybe next week. But there is a very simplified application. It's just a one-page quick application. And as long as you have experienced some downturn, so the second round, you're supposed to be looking at, is there still some uncertainty in your area, in your business, and your economic outlook? And if so, if you look at your 2020 receipts versus your 2019 gross receipts, if they've gone down more than 25% in any one quarter or for the whole year, you can apply for the second draw. And again, you'd be allowed to get that max of $20,833 or 2.5 months of your income from 19. You can also look at your 2020 year. If by chance 2020 was a better year for you than 2019 and it helps you get to that 100,000 maximum that you're allowed to calculate on, you can also use that in calculating what the amount of this second draw would be for you. If you did not apply for these PPP loans last spring, if you missed that window, didn't hear about it, just didn't think it was worthwhile or whatever, they are opening up the PPP program again for first round taxpayers, first round borrowers again. And that was supposed to open up this week, still waiting to hear for sure when that's going to open, but it is in the works. And right now that we are waiting for a new application. I don't believe we have that yet. So if you are a first-time borrower, again, get in touch with your bank or your CPA, and they should be able to help you through that. And hopefully you can apply for those funds by next week. And I'd highly recommend doing that. The big bonus to this program and the big draw certainly for borrowers who are applying for this is the fact that you can get these funds forgiven. So while they were called a loan, and you have to do a filing to request to get them forgiven, but the idea is that it's pretty easy to get them completely forgiven, and especially for self-employed individuals. It's a very simplified form that you can fill out to get that forgiven, and you'll get the whole amount forgiven and not have to pay anything back. So if you have not looked into those yet, highly recommend you do that. And I'm now going to turn it back over to Marie. Marie, if you're talking, you're on mute.
I'm sorry about that. Um, okay, next was keeping detailed expense records, which we already touched on a little bit, but we just wanted to reiterate that you do have to have good record of your expenses and any of your travel and mileage and business meals. You know, the IRS, what they would like to see is, you know, the date, how far you went, why you went, who you met with, how it was related to a business purpose. And it just also, if you have good records, it makes tax preparation that much easier. And okay, moving along. Another suggestion that we have is the idea of forming an LLC. Just to separate your personal assets from your business income. It's a good idea because there is some risk in your day-to-day operations. Most of you probably carry errors and omissions insurance, which will protect you to a certain point, but it might be a good idea to consider forming an LLC for your business. And as a member of the LLC, you personally are not accountable for the company's debt, and you're a little more protected if somebody were to sue you or such. And along with this line, it's also a good idea to set up a separate checking account, a separate credit card that's used exclusively for business. It just makes your record keeping a lot easier as well if you're not mixing it with personal expenses. And lastly, we don't want you to forget about the Ohio Small Business Deduction. This has been around for several years. This is a nice deduction on the Ohio return. Up to the first $250,000 of business income is just completely deducted, and you're not paying tax on that. And if your income is higher than the 250,000 limit, and the 250,000 is a married filing joint return. If you're filing single, then you're limited to 125,000. But either one, if your income goes over, your business income goes over the limit, that income is only taxed at 3%. So regardless of what your rate is, that is only taxed at 3%. And I think that about covers that, Amy.
Okay, so we do have a few questions coming in here so far, so I'll address those here before we see if anybody else has anything. First thing is, it looks like about the PPP loans. It says, don't you have to show lost income as a result of the pandemic? Yes, for the second draw, for sure. The first draw really was available just due to economic uncertainty. The first time the PPP loan came out last spring was really just a matter of, did you expect a downturn? Did you expect that there was uncertainty coming? And it was to get you funds to make sure you could weather that. And so really the first draw didn't have stipulations necessarily on drop of income at that point. And so that is still available and available for those, even if they at that point or at this point don't know what's coming. The second draw, the second opportunity to take money on this PPP program, yes, you do have to show a drop in income. That's where you look at your 2020 gross receipts and you compare them to 2019. You can either compare in total. I have some clients that have Schedule C small business type things like you do, who are just looking in total and saying, okay, this is how much I made in 2020 versus 2019. And if it's in total gone down by more than 25%, then you have a right to go for a second draw. If you, but you don't have to even look in total. You can look at an individual quarter. Most companies saw the biggest drop in second quarter of 2020. So you can look at just your second quarter earnings, your second quarter gross receipts for 2020 and compare those to second quarter of 2019. And as long as there was a greater than 25% drop in those gross receipts, then you would have an opportunity to apply for the second draw of this PPP loan. In addition, I mean, you still have to have some economic uncertainty. There still has to be a question of, could I have some downturn coming? I mean, the idea is that they're giving you this money to help you get through the next, 24 weeks. So, so that is still a stipulation as well, that you're expecting some uncertainty in your profession, and that you need these funds to get through it. Somebody else asked, they said they're new to real estate as of December. Is there anything with the PPP loans available? Unfortunately, no. You had to be in business on February 15th of 2020 in order to be able to apply for these loans. So that would not be available to you at this point. There's also a question about the mileage rate. The standard mileage rate for 2020 is 56 cents a mile. Do you remember what 2021 is 56 cents a mile.
Right, yeah.
What was 2020? Well, I already forgot.
2020 was 57.5. I meant to mention these when I was talking about it. Yeah, and then 2021, it backed down to 56 cents a mile.
Yeah, okay. And then you asked about meals. Somebody asked about meals. I think, the thing there is it has to be a business meal. So, if there's a business purpose to your meal, if you're meeting with a client, meeting with, a referral source or, whatever, or if it's that kind of thing, or food that you want to have set out at your open house, that kind of thing, those would all qualify. The stipulation for this 100% that's going into effect in 2021 is that food, that those meals and drinks are things that you purchase from a restaurant in order to get that 100% deductibility. All right, so that's all the questions I see there. Oh, and one more. So I see a question too about the PPP loans. If you did take them last summer in that first round, now is the time. If you haven't applied for forgiveness yet, remember they're not automatically forgiven. You do need to apply for forgiveness. There is a simplified form that should be coming out in the next week. Part of this Tax Stimulus Act here in December was that for all loans less than 150,000, the SBA had to come up with a simplified form for forgiveness, and that's supposed to be out, like I said, within about the next week. Another question about meals. So yeah, so for 2020 and prior years, the meals deduction was a 50% deduction. Going forward here now in 2021 and 2022, just the 2 years at this point, you can take a 100% deduction for meals that are provided by restaurants. All right, so I think that's all the questions I see coming in. One thing I wanted to comment on too, that Marie has talked about twice now about keeping detailed records, and just a note there too. It is tedious. I know it is sort of annoying to have to do that, but obviously with the GPS kind of stuff we have on our phones now, it's pretty easy to go back and calculate the miles that you drove. You don't have to necessarily have that, calculated when you're driving it that first time. You can always go back and figure those out later. And it's really helpful, if nothing else, just keeping it in your calendar. If you're keeping track in your calendar where you're going each day, it's pretty easy to go back and add that up. And then we have seen in IRS audits where even just having a calendar of meetings and where they're at is enough to substantiate the miles that you're taking. So keep that
Another
in mind.
suggestion I've heard is to just write on your receipt, like if it's a business meal, on the back, write down, who it was with and why you were meeting for the business purpose.
Right. No,
Neat.
that's an excellent idea. Yep. Yeah, and there's another question coming in about entertainment. So entertainment with the Tax Cut and Jobs Act, it used to be meals and entertainment were 50% deductible. Entertainment went to zero with Tax Cut and Jobs Act. So that started in 2018, where you could no longer deduct entertainment costs. That has not been proposed to be increased. That's not part of this 100% deduction. So unfortunately, entertainment's still at zero. I think they're just trying to support our restaurants at this point. Someone asked the question, I just got licensed in December. Do I need to file taxes this year or next year? So again, you're likely filing a Schedule C, which is part of your 1040. I presume you're already filing a 1040 anyway, so you would still be filing a 1040 form. It's just a matter of if you'd be starting your Schedule C or not. The issue is just a matter of, do you have any income or deductions to report? If you do, then yeah, you'd want to put them on there. If you have some expenses, even if you don't have any income, if you've got some expenses, it's probably worth putting those on there. I imagine you pay a fee to take that licensure test, put that on there. But otherwise, no, you probably don't have any income yet to report. All right, that's all I'm seeing. Anybody else have any other questions? Anything else we can help you with? As we wait and see if any more come in, just want to note too that today's webinar has been recorded, and so we are willing to share that. If you just didn't get enough of us in this half hour, we can you can come back and watch us again. So we'll make that available to you after the webinar. We can send that out, and then obviously for those who were not able to attend and wanted to, we can make it available for them as well. So I think that's it. I think that's all we have. Marie, do you have anything else you wanted to add?
No, I think that's about it.
Okay. All right. Well, very good. We're so glad that you all joined us. We hope that you have a successful real estate year. It sounds like things have been going really well, and well, unless you're trying to buy a house, then maybe not so well. But great for selling a house. So good luck. I hope your market stays strong, and we'll talk to you again soon. Thanks.